Hello traders, welcome back to new video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, an initiative by Tribe to empower traders with knowledge, tools, and community support to excel in the financial markets. Today's session is on mastering Forex trading during illiquid market conditions. Whether you are a seasoned trader or a newbie, understanding these strategies can protect your profits and minimize losses. So let's get started. Video part 1. Understanding illiquid market conditions, the challenges they present and strategies to manage these challenges. Alright, so do you know that trading during illiquid market conditions can amplify your losses if not handled carefully? What is illiquid market? When there is a lack of sufficient trading activity going on in the market, resulting in illiquidity. Means very few buyers or sellers are currently transacting in the market. And what are the signs of illiquidity? Low trading volume. You can see on the chart that the volume bars will gonna be very small. Alright, and the bid and ask price will have a wider spread, and that will gonna increase the cost of trading, because whenever you want to buy or sell at a specific level, then you will get so much of slippages because of this wide difference between the buying and selling prices. And the third is erratic and unpredictable price movement. A small trade volume can cause significant price fluctuations, making the market unpredictable. Illiquid market conditions can be challenging for traders as they create conditions where executing orders at desired prices become very difficult, leading to high slippages and potentially higher losses. And it can dent your risk to reward ratio also. So that is why understanding these conditions is essential for minimizing risk and improving trade execution. When do illiquid market typically occurs? Illiquid market conditions are not random. They occur during specific times or events. When market participation declines, means the activity of participants, or you can say the activeness of buying and selling from those participants decline. So what are those specific times? If you know that, then you can simply avoid trading in those periods when the market is showing very low activity. Alright, so let's see that. First is session start. We know that 24 hours a day and 5 days a week Forex market is running. But that doesn't mean that it have sufficient liquidity in it for entire day. So common time periods of low liquidity are: first is session start. Liquidity is at its lowest during the early part of Asian session start, before major financial hubs like Tokyo and Sydney fully open. This time is characterized by fewer market participants, especially for major currencies involving USD or Euro, which see higher activity during European and US session. So let me show you a chart which will help you understand that how and why the Asian start timing have low liquidity, because of the overlapping of markets. As you can see here, this is the Asian sessions opening around 5:30 to 6:30 am. But in this time, very few other global markets are open. You can see the major markets are European market, which opens at 11:30 a.m. So of course these activity will not gonna be reflecting in this time zone. And UK session, alright, so this also opens at 12:30 p.m. This will also gonna give you a lot less trading activity from 5:30 to 11:30 at least. Indian session is of course opening around 9 a.m. and then USA session is not active in that period, and this market have very high significance, alright, for on trading volume. So there is very less overlapping going on in these markets for 1 hour or 2 hour of time at the start. So that is why the Asian markets have very low liquidity when the session is starting out. So this is how you need to know that these periods. So New Zealand, the first opening is around 3:30 a.m. and in this time there is no other session is active. So of course in this period the currency pairs will gonna have a lot less volume than the volume is in this time period, which is around 12 p.m. because a lot of sessions are active in this period. Second is holiday periods. Global holidays such as Christmas, New Year's and Easter's significantly reduce market activities as institutional traders and major market players step away. National holidays like US Thanksgiving, Japan's Golden Week can also create low liquidity conditions in specific regions, affecting local currency pairs. Third one is weekends. The Forex market operates 24 hours a day and 5 days in a week, meaning trading halts on Saturdays and Sunday. Although some brokers allow limited trading during this time, and liquidity is almost non-existent at those periods, and the price movements are also minimal. So you have to avoid trading if your broker is allowing you trading on the weekends. Alright. Next is unpredicted situations that can cause illiquidity, like uncertain events. Alright. So the first one is political and economic events. Major announcements such as elections, central bank policy shift or geopolitical tensions can cause traders to pull back, leading to a reduced liquidity and increased volatility. For example, during unexpected announcements like Brexit voting results, market participants often withdraw due to uncertainty because too much volatility can trigger their stop or targets very frequently. So they just want to wait and watch that particular situation. And one more thing is, when multiple type of events are due, let's say GDP data and inflation data are due. So if GDP is showing you positive result and the inflation data is showing you negativity in the market, then both events can create a bit of uncertainty, and in that situation you just have to sit back and relax, because in those market events the market can be very much unpredictable. Alright, so that is also a cause for low liquidity in the market. Last is technical disruptions. Outages in major trading platforms or exchanges can result in temporarily illiquid conditions. Such disruptions prevent traders from executing orders and reduce overall market activity. So you also need to keep track of those technical disruptions. Now, how to identify low liquidity periods? Use historical data. You can analyze the past trading volume during specific times or events to understand when liquidity typically drops. Or you can track economic calendars to monitor holidays and scheduled events that might lead to reduced market participations. Then you can monitor trading activity. Watch for widening of bid and ask spreads, low trading volume and erratic price movements as real-time indicators of illiquid conditions. Understanding when illiquid market occurs allows you to plan your strategies better and avoid entering the market during high risk periods. Alright? So why are illiquid market conditions are risky? Lack of sufficient market participants combined with low trading activity creates challenges that can amplify losses and make risk management difficult. So you need to understand why they are very serious. First is amplified slippages. So first of all, what is slippages? Slippage occurs when an order is executed at a price different from the expected price due to insufficient liquidity. This is more common during illiquid periods when there are not enough buyers or sellers to fill orders at the desired price. And how will it gonna affect traders? Market orders are most vulnerable to slippages as they get filled at the next available price, which may be far from the intended price. For example, if you plan to trade in Euro USD and you want to buy it at the price of 1.1000, but if the volume is very low, there is illiquidity going on in the market, then your order might get actually executed at the price of 1.1010. So this 10 pips difference, or you can see this is worst price for by 10 pips. Alright, so this is called as slippage, and this will gonna cost you a disturbed risk to reward ratio. Next condition is wider bid-ask spreads. Bid-ask spreads is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. So during illiquid conditions, this gap widens significantly due to fewer participants in the market. And why it is risky? Wider spreads increase transaction cost as traders must pay a higher price to buy and accept a lower price to sell. For example, if a pair typically has a 1 pip spread in liquid condition, normal market condition, then it might can increase to 5 pips or even 10 pips during illiquid times, making it harder to profit. Alright. Then the third one is erratic and unpredictable price movements. In illiquid markets, even small trades can cause significant price swings because there are fewer orders in the order book to absorb the transaction. It will gonna impact you that prices can jump unpredictably, triggering stop losses very frequently, and it can also increase the frequency of margin calls as many stop losses and other orders are getting executed in spikes. When a trader is using tight stop loss, might see that his position is getting closed due to a sudden price spike, even if the market returns to the original level after some time. Means the microsecond spikes can create a huge pain for short-term and scalpers relying on precise entry and exit points. So that is why these short-term players should trade in only liquid market conditions. Fourth one is unfilled or partially filled orders. With limited market participants, your trade size might exceed the available volume at the desired price. Means you want to buy 100 quantity at a certain price level, but at that price level there is only 60 sell quantities are there. So out of 100, your 60 quantities will gonna filled there. your order will get executed for 60 quantities, but the remaining 40 will gonna get filled at worse price. It can be filled at higher price, alright? So there can be a chances of no order execution at all, or if the order is executing, then it might be only partially. So those unfilled orders can leave traders exposed to market risk longer than anticipated, and partial fills might execute the remaining order at the very worst price, and it can increase the slippage and hurting your risk to reward ratio. Managing slippages in illiquid market. Slippage is one of the most significant challenges traders face during illiquid market conditions. It occurs when trade is executed at a price different from what you expect, often due to lack of sufficient liquidity to fill your orders at the desired price. Managing slippages is critical to protect your capital and execute trades effectively. Understanding the cause of slippages. So, slippages occurs when the execution price of a trade differs from intended price. So the first reason is low market depth. Why it causes slippage? In illiquid market, the lack of depth means there are not enough counterparties to match your orders at the desired price. As a result, first reason is low market depth. Market depth refers to the number of buy and sell orders available at various price levels. In a liquid market, there are usually enough orders to fill a trade at the expected price. But why it causes slippage? In illiquid markets, the lack of depth means there are not enough buyers and sellers, means there are not enough counterparties to match your orders at the desired price. As a result, your trade moves to the next available price, leading to slippages. For example, if you place a buy order in Euro USD at the rate of 1.1000, but the market has limited sell orders at that price, so your trade might execute at 1.1005 or higher, means you are getting 5 pips or higher slippages there because there is very low market depth available. Alright, second factor is volatility in low liquidity. Liquid markets are more prone to sudden price spikes or dips because a single large order can significantly impact prices. This is particularly true during releases or unexpected events in low liquidity periods. For example, during an illiquid Asian session, a large institutional trade might cause a currency price to jump several pips, executing your order at much worse price than expected. So very few quantities of orders can move the prices in huge spikes also. So this can trigger your buy or sell orders without an actual breakout, or it can hit your stop loss levels without market going beyond that particular level. Means there was just a microsecond spike, and in that microsecond your limit stop loss orders or limit buy orders can hit, and still the market moves in your favor. So you are already out from the market because of that particular spike. So that is why you need to be aware of volatility in low liquidity factor. Third is large order sizes. If your order size exceeds the available volume at the current price, the trade will walk the order book, filling at progressively worse prices. And the reason is that large traders need more counterparties to execute, which may not be present in an illiquid market. For example, if you place a 10 lot order, the first few lots might fill at the desired price, but the remaining lots might execute at worse price as the market absorbed your order. And it is very obvious, if you are buying at 1.1000 for 10 lots and the volume there, selling volume, is just 5 lots, then your 5 lots will get executed at 1.1000, which is your desired price, but the market will walk the order book, means it will gonna execute the next 5 lots at the second price level where enough sellers are available. And the fourth factor is latency in execution. Latency refers to the delay between placing a trade and its execution. In fast moving illiquid markets, even a small delay can result in significant price changes. By the time the price may have moved due to low numbers of orders available. For example, placing a market order during a news event in an illiquid market might result in the order executing after a price surge caused by other traders reacting faster. So you have just placed a buy order with the help of market order, alright, and you just punched it and the execution is delayed by a few seconds. Then your execution price may differ from the actual market price because the market is moving too fast and the volume is not there. So you will get an unfavorable execution. So we have discussed some factors of market slippages, but now let's see how we can reduce the slippage. One of the most effective way to manage slippage in illiquid market is by using limit orders instead of market orders. Limit orders give traders more control over execution prices, ensuring that trades are executed only at or better than specified price. So we have already covered what are limit orders and market orders in detail in our risk management video, so you can watch that. A limit order is a buy order or sell order at an specific price. So why use limit orders in illiquid markets? It will provide you control over execution price. Limit order prevents your trades from being executed at worse price due to thin liquidity or sudden volatility, and it will help you avoiding unexpected cost. With market orders, you might end up buying or selling at significantly worse price, especially when spreads widen or large orders will walk the book. Limit orders eliminate this risk, and it will also help you to adapt for thin markets. During low liquidity, a limit order helps you patiently wait for the market to reach your desired price instead of chasing prices with a market order. Now, how to use limit orders effectively? First is set realistic limit prices. Place your limit orders at realistic price levels based on the current market conditions. For example, if you are trading in Euro USD and the bid and ask price is like this, 1.2000, and ask price is 1.2002. So if you place a buy order at the price of 1.1995, then it will gonna give you better control compared to market order, because there is no slippages if you have placed a limit order at this price. Then second factor is to combine with support and resistance levels. Use technical analysis to identify key support and resistance levels where the price is likely to reverse or pause. Place your limit order near these levels for higher success rates, and then adjust limit order during high volatility period. During news events or volatile periods, widen the range of your limit price slightly to improve the chances of execution while still protecting against large slippages. Last is be patient. Unlike market orders that execute immediately, limit orders require waiting for the market to reach your price. Patience is the key when trading with limit orders in illiquid market, because we have already discussed that in limit price, better price is guaranteed but execution is not guaranteed. On the other hand, market orders guaranteed the execution, but the best price may not be guaranteed by market orders. Alright. So next important factor is to reduce the slippages in market is trade smaller lot sizes. Trading smaller lot sizes is an essential strategy for managing slippages and mitigating risk in illiquid market conditions. Large orders can significantly impact prices in thin markets, leading to unexpected cost and poor execution quality. So let's see how and why you should use smaller lot sizes. First is, it will gonna reduce the market impact. In illiquid markets, a large order can move the market. Smaller lot sizes reduce the likelihood of creating a price imbalance, ensuring more stable execution. And a smaller lot size will gonna improve fill rates. Large orders may remain infilled or partially filled due to lack of matching counterparties at your desired price, but a smaller lot size will gonna have enough counterparties to provide you opposite liquidity, and that will gonna improve the order execution rate. Then of course, smaller lot sizes will have lower slippage risk because smaller orders are less likely to walk the order book, where trades are executed at progressively worse price as the market absorbs the order, right? And it will gonna enhance flexibility. Trading in smaller increments allow you to scale into or out of positions gradually, improving control over your average entry or exit price, and it will also gonna help you in providing you better risk management controls. Or you can use scaling strategy to enter or exit trades gradually. For example, if you are a breakout trader, then enter with 50% of quantity on the breakout and add the remaining 50% quantity based on market closing, or if you see that breakout is about to succeed, means the breakout is not fake, then you can add other 50% quantity. It will gonna impact the slippages, plus it will gonna have better control on risk management. Or you can monitor your broker's minimum trade size and commission structure to ensure smaller trades are cost effective, and combine smaller lot sizes with low leverage trading to reduce risk further into volatile or illiquid market conditions. And what you can do is avoid trading during major mixed news events. So why news event causes slippages? Major news releases such as non-farm payrolls, employment data, or central bank announcements, GDP data. These type of data can cause significant volatility, especially during illiquid periods. Slippages is almost guaranteed in such scenarios. So what you can do? You can use an economic calendar to identify high impact events and market having mixed views. Mixed views means one data is giving you negative signs and the second data is giving you positive signs. So in that situation, the market is in very much uncertainty, and when there is an uncertainty and the market is very illiquid, then you will see very big spikes there, and those spikes are not in our control. You cannot sail through that particular spike hurdles. So what you have to do is you can minimize the quantity, or you can close your terminal on those events which have mixed views. And what you can do, close your position or avoid entering the market during news releases, especially in low liquidity environments. Then technology and tools to control slippages. Use brokers with low latency and slippage control. Low latency execution means it will gonna ensure you faster trade execution and reducing the likelihood of slippages. And choose a broker with a strong server that can direct your trades to exchanges very fastly. Then slippage protection features. Some brokers allow you to set a minimum slippage tolerance, cancelling order that exceeds this limit. And you can also use this thing by manually. If your broker is not allowing, then you can use it by watching the spread book. Okay, we will gonna discuss it in detail in the wider spread section. And next is maintain a good internet connection from a reliable internet provider that ensures a smooth connection. Alright, because many times your internet take a little bit of time to send the order to the broker, and then broker will gonna send it to the exchange. So there is a lot of latency going on, but a good and reliable connection can mitigate this risk. Then trading infrastructure. Devices for trading like computer laptops, mobiles or tablets must be properly working and should not glitch while placing orders, because if your system is also slow and it is giving you a lot of glitches, so that will gonna increase the chances of slippages. So you want to have a better trading infrastructure available. Strategies for trading in illiquid market. Trading in illiquid market requires a disciplined approach, precise timing and robust strategies to minimize risk and maximize profitability. This section provides actionable strategies that trader can use to navigate low liquidity conditions effectively. So let's get started. First major problem is wider spreads. The increased difference between bid and ask price are the common challenges in illiquid market. These wider spreads can lead to higher trading cost and create difficulties in entering or exiting positions profitably. Understanding how to tackle wider spread is crucial for preserving capital and improve execution efficiency during low liquidity periods. In high liquidity markets, spreads are narrow due to abundant buyers and sellers, and the spread are widened because there are fewer participants. We know that those participants are not willing to trade at competitive prices, so that is why the spreads are much higher. The difference between bid and ask is higher. So why spread are risky? So first is higher transaction cost. Wider spreads means you pay more to enter and exit a trade, reducing profit potential. Then second is difficulty in order execution. Wider spread can lead to slippages and unfavorable fills, means your orders are filling at worst prices, and particularly large order size have higher slippages or unfavorable order execution. Then the last is misleading price signals. Wider spread can distort price chart and create false breakout signals. So this is the main problem. Now, what are the strategies to tackle these problems? So the first is avoid breakout trading. Refrain from using breakout strategies that rely on high momentum and liquidity, because during illiquid conditions, breakouts often signal false and erratic price movement. You can see on this chart, when the price approached for breakout, the participants showed a low volume activity here. In the first attempt, we have very low volume or very low buying volume actually, and when it pushed down again, the volume started to decline, and on the next attempt also the volume was very dull. So this has failed this particular breakout, and on the selling time the volume has spiked in these volume bars. So try to find opportunities which have higher probability and high liquidity in case of breakouts. Next factor is to trade during high liquidity periods. Timing your trades is the most important thing to sail through the illiquidity periods. So what you can do is you can use overlapping method. Overlapping means there are multiple forex market are running around the world, and all of the markets have different opening and closing timings according to their time zones. So if you can see this chart, the New Zealand opening is around 3:30 am, and at that particular time no other forex market is open. So we can say that in this period no overlapping of any other market is going on. This is trading alone. So these participants from these markets are not trading in this particular time period from 3:30 to 5:30 am. So refrain trading in this time zone, and you can see in at what time the major markets are overlapping with each other. So you can see from 9 am to 2:30 pm. This is the highest peak time where almost all of the markets are opening. And again, this time period also have higher significance because these three markets are open, and at the same time the USA market is also opening at 5:30. So this will gonna give you very high liquidity because usually US market have a lot of volume coming in because major currency pairs are in USD quote and base. Alright, so try to trade in high liquidity overlapping periods. Next is avoid trading exotic currency pairs. We know what are exotic currency pairs, or you can say those are minor currency pairs which are from developing countries. So what you can do is avoid trading in those currency pairs like USD BRL, Brazilian Real, USD offshore Chinese Yen, or USD versus CZK, USD versus DKK, Danish Krone and Hong Kong dollar. So these are exotic currency pairs. Alright. So what you can do is focus on trading major currency pairs like Euro USD, GBP USD, USD JPY, and avoid these kind of pairs because these pairs have very low liquidity in them, and the spreads will also gonna be very much higher. Alright, and volatility will gonna disturb your trading setup. But let's say you find a very good opportunity in illiquid market situation and you want to trade it. You do not want to shift to any major currency pair, or you do not want to wait for overlapping market period, then you can use range bound strategies. These strategies are particularly effective during illiquid market conditions as price often move within defined ranges instead of forming strong trends. By identifying and leveraging key support and resistance levels, traders can capitalize on price fluctuations without relying on breakout movements, which are less favorable in low liquidity environment. So what you can do is you can identify good support and resistance level and employ some range bound indicators like stochastic or RSI to get good confirmation from that, and buy at the low price and you can sell at the high price. So this will gonna reduce the wider spread risk and high volatility movements. So here in range bound strategies, you will be trading in a little bit safer environment in comparison to trending markets. Next is set realistic stop loss and take profit levels. So what you have to do is place stop loss orders slightly outside the range boundaries to protect against unexpected breakout. You see, when the liquidity is very low and market is approaching any support area or resistance area, then very few orders can actually trigger massive moves beyond these resistance or support levels. So these spikes can hit your stop loss too much frequently. To avoid that, use a little bit outside the ranges as your stop loss, and take profits should be just below any major resistance or above any major support area. You can see on this chart also that this is a major trend line going on for this currency pair, and you got this range breakout situation from this price, and it moved up toward the resistance area to test this resistance and then spiked down. Alright, but if you have set your profit target without looking at this resistance line, then it might have missed the potential of this profit and it might have reduced a lot of unrealized gain from here. So it is very important to set realistic stop loss and take profit levels according to technical analysis and after taking confirmation from indicators. Till now, in this video, we have covered the basics of low liquidity, what are slippages, how to tackle wider spreads, and how to employ your trading strategies in illiquid markets. So make sure to use these factors while initiating trades in illiquid markets. That's all for this video. Make sure to subscribe to our community channels to stay updated. Thanks for sticking around. If you found this video helpful, there's plenty more to come in our series on Forex and technical analysis. And don't forget, for all your trading needs, visit tribe.com. For more in-depth trading education, head over to tribehub.com. Thanks for watching, happy trading, and I will see you in the next video.